Yeah, okay. Hi, everyone. Good morning. While everyone's coming in, I'm actually going to take a page from Gary's book and ask you a really quick question just to break the ice, just to get things going. Yeah, since the holidays are coming up, I wanted to know what was your favorite thing to do during the holidays?
I always like going to grandma's house.
Ooh, that's fun.
She,
Definitely. Here,
she,
here it's an automatic thing.
she had everything, right? She had the ribbon candy, she had pie, she had just, it didn't matter. She always had everything. And I didn't get this big looking at food. I'm going to tell you that right now.
Yeah, like your diet, just nope, no diet. What diet? During the holidays, it does not exist. Okay, so anyway, good morning, everyone, and thanks for joining us for today's session of Cash Flow Mastery Talks with Cashflow Mike. My name is Jessica Cordero. I know I'm a new face. I'm from Insightful Accountant, and I will be your host today. Yeah, and today we'll be joined by Mike Milan today, and we go over the session's topic, managing accounts payable, enhancing cash flow through efficient payments. I'll have him introduce himself in just a bit after I cover a few of the housekeeping items, which are there's actually no CPE for this as it is just a 30-minute webinar. If you have any questions, please enter them in the Q&A panel, and I want you guys to be specific. Don't just say, hey, Mike, what do you mean? You gotta ask, what did you mean by you want to go to grandma's? Mainly just because he might not get to your question right after you put it in there. And we'll actually be sending you a link to the recording, and it's also going to be up on our YouTube page within about 24 hours. And I'll also be putting the link to the YouTube channel into our chat, as well as the copy of the slide deck. Okay, with that, Mike, I'm done. Welcome, and thanks for being here.
Hey, live from San Antonio is Cashflow Mike. Let's get going. Come on. This is Cashflow Mastery Talks with Insightful Accountant. And I got to tell you, they're doing something cool right now this week. November 11th is Veterans Day. And if you guys don't know me at all, I mean, I spent 16 years in the military. So what they're doing is kind of cool. They're reaching out to us. If you're a veteran, submit. They just got a simple form on their website. Submit that you were there. They're just acknowledging those of us that served. And I want to thank you and appreciate what you guys have done or gals have done for the country. So it is Veterans Day. They're doing a good thing, reaching out to us to thank us for our service. So make sure you let them know you were a veteran. So I appreciate that. And I think Jessica's going to put the form. There it is. It's in the chat already. So there you go. Today we're talking about AP. AP. So here's the thing. I thought I'm going to surprise this group this month with something new, something they hadn't seen, something that was going to blow your mind. And I presented it to my Wednesday morning group to kind of do a rehearsal, a run through, and it kind of flopped, right? It was going to be it was going to be too complex. So I switched gears just a little bit. So the end of this might seem messy, like Larry Weinstein or like Don Odell might tell you because they saw the first run of this morning. But I think I have a fix for it. I think I have a fix, and you're going to really like it. So stay tuned to the end of what we're going to do. So we're talking about AP. So let me get my slideshow up. There we go. And we've got the slides in there, and they changed just slightly over the last 10 minutes, but it won't affect what you're going to see. So the slides are already in there in the chat. So let me go share screen, and you can follow along. It's the Cash Flow Mastery Talks, and here we go, right? So here's one of the reasons why Cashflow Mike wants to talk about AP. And we're not going to talk about, hey, use this software, do these things, do this automation. No, when I teach, I want you to know the concept. I want you to be able to apply it. I want you to be able to, more importantly, talk to others about why it's important. So here's the thing about this whole cash flow mastery series, right? I always got to kind of bring this up at the beginning of why I'm doing this. And I'm on a mission. I'm on a mission to eliminate cash flow as a reason that businesses fail, right? That's my whole thing. And I'm doing that through a combination of education and software. And I want you to help me do that. So if you need to learn concepts, if you need to work through things with your clients or even yourself, let's do this together, because I want people to fail for other reasons, but I don't want it to be because you can't manage cash flow or you can't master it. So let's do that together. Here's the reason why. Right now, on average, there's 18,000 bankruptcies per year. Here's something cool about that. It's down. Pre-pandemic, right after 2008, when the bankers burnt the world down, that number was up to 50,000 per year, and it's down to 18,000. So there's been incredible work done by folks like you to put people back in business. The overall trend is down, but here's what's happening since in the last 12 months, right? So the last 12 months, 2022, 2023, that number is creeping back up. We had it down as low as 12,000. It was up to 15,000 just in that 12-month period of 23. They're still averaging over the course of the last decade around 18,000. But the most important part that I'm going to tell you about is right here. Of the people that file bankruptcies, when they go to court and they submit their financial statements, 35% of those have net profit on the books. Think about that. They're making money. They just don't have any. They can't pay their bills. So part of the reasons why I want you to master cash flow and be able to determine what's coming in versus what's going out and balancing it is because I don't want you to feel like you're making money and not have any. Right. So that's why these talks are important. That's why I partner with Insightful Accountant to do this. And that's why we can do this together. So let's talk about the accounts payable ratio. First of all, you're like, oh my God, it's 10 o'clock in the morning, Mike. We're going to do math right off the bat. Yeah, we're going to do math. Anytime you come to a cash flow, Mike, presentation, you're going to learn a little bit of math. So we're going to talk about accounts payable ratio. And first of all, I'll tell you something about ratios. They don't mean anything unless you compare them to something else. It's just not like going, hey, I got a 2. Well, what does a 2 mean? You got to be able to explain it. So I always put everything to the shame test. So when we go through this, listen to how I explain it, because there's a formula that I use to communicate. It's the same thing no matter what ratio. I can take you through any ratio that you have based on this formula. And it's talking about the denominator first and then the numerator second. So think about that in your mind. So the accounts payable ratio calculation is simply this. You take accounts payable, and in this case, you're going to divide it by cost of goods sold, right? Because what I like to do is optimize for inventory in this. I mean, if you had service companies, you got an operating expense or whatever expense you want to take it to. But in this example, I'm going to stick here. So accounts payable, when you look at your balance sheet, that's the number that you see, right? That's just how much you owe. How much that I owe my folks, and this is how much I spent. Remember, your inventory is an asset until somebody buys it, then it becomes an expense. So we're talking about expenses down here. These are bills that I owe. These are things that I've paid, right? So if I'm talking to Shane is my best friend who doesn't know anything about these. I'll look at the expense versus the bill. I'm saying, hey, for every dollar you've already paid, that's the denominator, you still owe, $893,000 in this case, or $893. That's kind of the ratio. Now, what we're going to do, though, you see this extra part. I'm going to multiply that by 365. Why? Because it converts it to days. When I was a state trooper, I used to measure speed in miles per hour. Now I measure it in days, right? That's part of being in business. We measure speed in days. And I talk about the speed of cash because you want money to move fast. You want money to move fast to you and through your business and into your bank account, right? So speed is important. That's why we measure things in days. So this calculation converts things to AP days, which is really how much do you like your vendors? You like them so much that you're willing to pay them either fast or slow, right? Fast or slow. And we'll talk about what's better. Should I pay early or should I pay late? But that's the AP days. How fast should I be paying? In this case, if we take 893 divided by 58.55 and multiply it by 365, you get 56 days. Now, it could be a long number, some decimals after that. I always round it to what's closest, right? Because we don't think about things and it's 5.5 days. That means by noon, we're going to end the, we should get a check by noon. No, it's just in the whole day. So use round numbers here. So 56 days. So is that good or bad? Well, we don't know because I just told you it doesn't matter. It doesn't mean anything until you compare it to something else. So in this case, I know the industry average for this company, and the industry average is 34. Now you're like, well, Mike, where do I get the industry averages from? If you don't know, I mean, some of my stuff has it built in, but if you don't know where to get it, the SBDCs have access to your industry averages. So if you got one in there in your local area, contact them. They can probably give it to you for free. I used to like to use the banks, right? So I had a relationship with a banker. I would call the bank. They all have access to this thing called RMA, Risk Management Associates. And what that is kind of a collective of banks that put in anonymized data so they can do these industry averages. They have a database. You just give them a NAICS code, which is NAICS, North American Classification or Industry Classification System. You give them that code, they can give you a sheet of paper back. So there's plenty of free resources out there. And of course, there's some paid ones as well. But the free resources are pretty easy to get to. All right. There you go. Yeah, Kathleen at 11 o'clock there. So yeah, it's good. You work math all the time. Kathleen's actually coming to San Antonio. I get to meet her and see her in person next month. So that's going to be really cool. All right. So let me ask you this in the chat. When you see 56, 34, 34, is this good, fair, or terrible? What do you think? In the chat, just throw it in there. Good, fair, or terrible? You see one number at 56, you see one number at 34. So let me see some answers. Good, fair, terrible. You can even put G, F, or T. I can understand what you're meaning there. So anybody got an answer? G, F, or T? T. Alyssa says T. Larry says F. Okay. Let me get one more. One more person. We got one person thinks T, O, F, F, T, fair, terrible. All right. Here's where it's really interesting. I'm seeing some F's, I'm seeing some T's. What if I told you this is actually good? Right? We got F's and T's on the line already, but I'm going to say it's good because I'm going to explain it to you a different way. What if I say that, hey, I pay my bills in 56 days, everybody else pays their bills in 34 days? You're like, oh, that's terrible. Well, it depends on how you look at it. From a cash flow perspective, when you're able to stretch your payables, you're actually able to leave cash in the company longer. It doesn't mean that you don't owe it. It just means that cash has not left your business. So I would go with either good or fair here, meaning because as long as you're not hurting your relationships, as long as you're not hurting your pricing, and I'm going to go over the pros and cons of each of these, but as long as you're not doing that, paying later than industry average is good for cash flow. It seems counterintuitive. It really does. But you're keeping cash longer. So what I suggest is always keep it around the industry average. And I'm going to explain why in just a second. So the other thing you'll see this as, this is just converting it to days, but there's also this notion of a turnover rate. And some people get those confused, like what's turnover versus days? Well, days is just how long it takes you to get to pay your bill. That means that invoice sat on my desk for 56 days before I decided to pay it. The turnover rate is how many times per year I'm actually making that payment, right? So how many times a year do I do that? So it doesn't matter because 365 and we divide it by 56 equals 6.5 times per year. That means I'm really every other month, I'm kind of paying this vendor, which makes sense, right? 60 days every other month. It's just about that. So 6.5 times a year, I'm making this payment. These two things mean the same thing. You're just describing how often you pay a little bit differently. So when you think turnover rate, just think how many times per year do I have to do this? Or days is 60 days. Well, every 60 days would be 6.5 times through the year. So that's kind of the difference between turnover rate and, days. So I told you why this is important, right? I mean, we're trying to eliminate cash flow, but I want to show you why it actually works better from a cash flow perspective. When I say it's good when your actual AP days are longer or more than the industry average. And let me show you kind of graphically what I mean by that. There's a concept that I teach called the financial gap. And what you got to know about gaps is when you just think about it. You think about it and go, well, a gap, if I have to jump over a gap, I want to jump over a small one. I don't want to jump over a large one. I mean, especially some of them, they're too large for me to even jump over. So the smaller the gap, the better it is. That's the same thing in your business. This one gap, this one calculation will help you understand how much money your company needs. Most people will know how much they have, but nobody really knows how much they need. And one of the things I teach is how to understand and how to calculate how much money your company needs. Meaning if your business has ever felt clunky, like, oh, I'm always waiting for money to come in before I can do something else. Well, that's because this gap has gotten out of whack. it's gotten too large. When the gap's too large, it takes more money to run your company. The smaller the gap, the less money it takes to run your company. You have to put that in your brain. The smaller the gap, the less money it takes to run. So a couple of different things. Now, inventory's on here too, right, Larry? I mean, you saw this today and you go, hey, you forgot inventory, Mike. Well, I understand, but we'll get to that in 2 months, how inventory plays into this. So right now we've got accounts receivable days. This is just the amount of time that I'm waiting for my customer or my client to pay their invoice. I know they got the invoice and it's sitting on their desk. It just takes them a certain amount of time to do that. In the meantime, some people look at these as silos, AP, AR, inventory. They're not. All of these things happen at the same time. So you layer them, they're on top of each other. So AP is happening at the same time AR is. And so this is the amount of time it takes me to pay my bills. The difference between my customers paying me and me paying my vendors is known as the financial gap, right? The financial gap. And again, we want this gap to be small. And there's really only two ways to make it small in this scenario. There's only two ways to make it smaller. Oh, look at that. Even Zoom agrees with me letting balloons go. First of all, we can collect faster. We talked about that last week, ways, and I came up with some unique ways, to be kind of interesting and unique to collect faster. But the other way is we can pay a little later. We can hold on to the invoice because what we're trying to do is make that gap smaller. So there's only two ways to do that. You can shrink AR or you can lengthen AP. That's why I'm saying the longer you kind of sit on an invoice, the better. Now, that's where I'm telling you that you can get in trouble here as well. But it all pertains around this notion of a financial gap because it is a double-edged sword. When you're talking about either inventory or AR or AP, I want you to think about maintaining the industry average because then you have moves. You can move left or you can move right. You can pay a little early, you can pay a little late. But if you're at the industry average, you're doing what the market expects. You're doing what your vendors expect when it comes to AP, right? But there's pros to paying early, there's pros to paying late. There's cons for paying early, there's cons for paying late. That's the double-edged sword is that you can make a mistake either way. You can benefit either way. What I say is keep it at the average in the middle, and then where you can move left or right when you have to, pay early or pay late, and it doesn't hurt your relationships. I'm going to go over some of the pros and cons of this, right? So let's talk about, first of all, paying early. What if I pay early? So you probably seen this. You probably have done this, in your home or your office. Let's just make a pros and cons list. Well, that's what I did for you, right? I just made a pros and cons list of each. More importantly, so you can explain it to your clients why these things, why you're suggesting one way versus the other. So if I pay early, yeah, I might be getting a discount, which by the way is what I'm going to discuss at the end. Should I take the discount or should I not? And good relationships could mean, hey, I get better terms, I get better service, maybe I get better pricing. Of course, you get better credit. You're showing that you're financially responsible. Banks like to see that you're keeping on top of your bills. And there's opportunities in negotiation. It gives you a little bit of leverage in your negotiation when you're paying a little early. Now, that's cash flow dependent. That means I actually have to have cash flow and it doesn't hurt me because the con is I could be tying up cash I could use for other things. I don't want to just strip all the cash out of my company to pay bills early because I might need it for something else. Like in my hotel staffing company, I had to make sure going into every payroll every 2 weeks that I was conserving as much cash as I could going into the payroll week. And that way I could be a little loose on the off week, right? I could catch up bills. I can make investments. I could, pay dividends to myself. I had to understand what that cycle was. So I would conserve cash the week of payroll, and I would, try to make bills and all that type of stuff the week off, the off week. So I can miss out on other opportunities because I don't have the cash. And again, the cash flow impact. Here's the other thing people don't think. If I'm already giving the money away and something pops up, well, I'm kind of stuck, right? It actually hurts me. So if you want to know how much cash you should have and you don't know, two different metrics you should go by. One, try to maintain 3 to 6 months operating expense as just a cash reserve. Put that as your set point. If you're spending $10,000 a month to run your company, hey, have $30,000 set beside. You're like going, why that much? Why that? Because most seasonality is about that long. You got seasons that happen about 3 months. You have an off season, you have an on season. The other thing is that people don't expect it isn't always COVID that disrupts a business. It isn't always COVID. Sometimes it's a death in the family. Sometimes it's a hurricane or a tornado. Sometimes it's just an illness. It doesn't matter. There's all these things that could disrupt a business. And by having that little bit of cushion, it's a lot easier to weather that because it buys you time. It buys you time to be able to make other decisions on working out of it. So that's why I say that. Now, there's another metric out there called days cash on hand. And I talked about this the other day, and I call it days to bankruptcy, right? And I think Larry would say we're talking about the runway or the burn down rate. The problem with that calculation, to me, the problem with that one is that it assumes no sales or low sales, right? No or low. So most of us have ongoing concerns. So the sales isn't the hard problem, but that's why it's days to bankruptcies. If sales stop, I can only afford this much more business. Keep that number at a minimum at 45 days. Right. So if you're calculating that or you see it somewhere in an automated calculation piece of software, whatever it is, you want that number to be 45 days or higher. Anything lower than that starts to indicate a cash flow problem. So 45 days or higher is kind of the answers to that test. So that's, again, what if I'm paying early? Now, the other thing is, what if we pay late? Right? What if we pay these things a little bit later? What's the pro? What's the con? Well, paying later, there's some pros. I keep cash in my company longer. I have options with what I do with it. I'm in control. Once I give it away, somebody else is in control. You can also take advantage of things, right? There's threats. I just described threats going on in your company, from weather to illness to personal relationships. It doesn't matter. Things can hurt your company. The other thing is you might have other opportunities. You might have the opportunity to buy into another company or invest in another company or add a truck or these type of things. There's other investment opportunities that you might be missing out on because you don't have the cash to do it. Yeah, Larry, he who has the goal makes the rules. That's right. So cash flow flexibility, meaning, hey, I can maintain a more consistent cash flow and reduce the risk of cash shortages. The fast money formula that I teach tells you how much money you have versus how much you need. And if you're short, it tells you exactly how much you're short. So if you have to raise money or go get a loan, you know exactly how much to add. Or you could start pulling levers. Like, what if I just sat on invoices an extra 5 days? Instead of paying in 30 days, I pay in 35 days. There's a calculation that tells you how much better your cash flow is going to be because you use that extra 5 days. Now, the cons to this, right, is that vendors could beat you up, right? They could charge you with fees. They could charge you with interest. They could just cut you off completely. They could just say, listen, I don't like waiting 56 days to get paid. So I'm either not going to do business with you. In the restaurant business, I saw vendors go from, 7-day terms or 14-day terms to cash on delivery, which means I don't trust you anymore to pay your bills. When I turn over your tomatoes, I want cash up front, right? So there's things that vendors can do to actually hurt your business that way. The other thing I see is that they may be adding additional costs to your pricing because they know that historically you pay late. They could actually be just adding on, say, hey, listen, add 10% onto his prices because we always got to wait. So if we're going to wait, we're going to get paid. And you could be missing out on those discounts. Here's the thing, legal issues. Yeah, you can always end up in a legal issue or lawsuit or anything like that. That's probably the least of my worries right now, unless I'm not paying at all. And I'm not suggesting to do that because the double-edged sword that I'm suggesting is keep it at the industry average. And if you run into a short-term cash crunch, you can sit on an invoice for an extra week or two to work your way out of it and then pay it and get back to average, right? So use that as one of the levers in your business and, your cash flow machine to be able to make a positive impact on your cash flow. So the question everybody's asked, this is where, okay, I'm going to tell you a secret. I totally flubbed this morning. I mean, Normally I'm pretty smooth, and when I understand it and I can take complex financial situations and simplify them. Oh man, I let you down. I've got to tell you that I just absolutely let you down. I was working out a calculation that was simple to do, that any of us could do. Should I take the discount if it's offered, or should I not? And I was trying to combine two different things. One is the net present value, which is, what's a dollar worth today versus tomorrow, and also the time value of money. Should I take the discount? Is the discount that I get today worth more than holding on to the invoice and keeping that cash for an additional 20 days or 30 days or 50 days, whatever that is? Well, I let you down. All right. I let you down, but not in the way that you think, because I'm this close. I thought I was going to have it done by this, but I didn't. I started putting it in a spreadsheet to make it simple, but it has to do with, these variables. When you're considering whether or not to take the discount, I want you to think about how much is the discount? What's the actual rate of the discount based on the invoice amount? When is it due? Meaning when days to discount, which is if I go to 11 days, maybe they don't give it to me, but at 10 days they do. How soon do you normally pay? Not the due date of the invoice, because we already saw that this company that we did in our sample was 56 days. So how soon do you pay? And then, of course, the invoice amount. The biggest thing is the difference between these two, the discount days or discount to payment. Now, Don Odell made a super sharp comment today, this morning. Don Odell says some companies don't pay attention. They don't enforce their discount days, which means they'll still give it to you on day 11. They'll still give it to you on day 15. They'll still give it to you on day 30. All you got to do is ask for it. So that's a variable you got to put in there. But even if I give you this formula, there's other factors that you have to consider. Like, are you earning interest? That complicates it. Does it hurt you from a cash flow perspective? Can I not make payroll because I paid an invoice early? So there's some things, and that's why I give you the set point of 3 to 6 months, because if you start dipping below that, chances are you're going to start hurting your cash flow, and paying your invoices early are actually bad for you. So don't pay attention to this right now, because you don't have to do it, because I tell you, I did it for you and it got super complicated. And here it is, we're doing exponentials, right? I'm like going, who on this call, Cash Flow Mastery Talks, is going to do an exponential? Nobody. So then I said, okay, we'll just use Excel. Here's how you do the exponential. It's like 1 divided by the power of, the actual discount rate, and 46. 46 was 10 minus 56. So see, I'm already confused just even trying to tell you about it. So skip this. Don't worry about this. But I'm doing this for you. I started to where you could just enter these things in. Hey, how much is the invoice? What's the discount rate? What's the discount amount? Days to discount, days to payment. I'm putting in not only the net present value, but I'm putting in the advice. Not favorable, take the discount. Favorable, take the discount. This ain't ready yet. It's going to be my discount decision calculator that I'll give you. If you want it when it's done, send me an email that says, I want the decision calculator or discount decision. You can put one word in there, discount. And when I have this spreadsheet done, I'll send it to you. So send it to Mike@cashflowmike.com. When I have this done, you'll be able to advise your clients, should they take the discount or not, when I have it done, which I'm hoping will be today, if not this week. So I'm Cashflow Mike. I always love coming here for 30 minutes. If you haven't already, go to my website, cashflowmike.com. Get a free copy of my ebook, The 7-Minute Conversation, How to Analyze Any Business in 7 minutes or less. Join my free Facebook group, because I got all kinds of these type of resources in my free Facebook group. Just look at guides and you'll see all the things that you can ask for, and I'll just send it to you. The Clear Path to Cash. That's the Facebook group, The Clear Path to Cash. I do have a podcast. If you want to hear stories about business, beer, and BS, well, Mike Milan, Blaine Birch, Mike and Blaine is the name of our podcast. We're on all the podcast directories. We're going to be hitting season 4. We've done 115 episodes, getting a few thousand downloads a month. So we're not rock stars, but we're also not schlubs either, I guess. So we're doing okay. And then if you want to know more about what I do, just email me at mike@cashflowmike.com. thank you. Thank you for coming. Thank you for allowing me to do this. And I'm going to turn it back to Jessica over at Insightful Accountant.
All right, perfect. Mike, we actually have a question in the Q&A. It's from Miriam.
Okay.
Yeah, so she asked, is the PowerPoint going to be made available? I will actually send that again in the chat just as we're finishing. So yeah.
Yep. Yeah, it was up at the top. The only thing that's not in there is the picture of the spreadsheet. Everything else is
Yeah.
in there.
Okay, so I will be putting that up again right as we're ending because I did put it up there at the start of the webinar, so you might not have caught it. Yeah, and I will also be adding the Veterans Day form just again, just so in case you guys might have missed it. And actually, that's it for the day. If we don't have any other Q&A questions. Yeah. Thanks everyone again for joining us, and thank you, Mike, for sharing your wealth of knowledge with all of us. Thank you so much.
See you next month.
Right. Bye.